Now, the Treasury Bills market remained on the quiet side as market participants looked to today's 213.4 billion naira Treasury Bills auction. Now, traders at Access Bank say they expect the quiet sentiment to persist with a bearish undertone. Dimeji Obasa, a fixed income dealer at Access Bank, joins me now for midweek market updates. Thank you so much for joining us on the show today, Dimeji. Let's get into the nitty-gritty of today's transactions, especially barely 24 hours after the rate hike from the Monetary Policy Committee. How is this affecting the market and investor sentiment?
Good morning. Thank you very much for having me. So what we've seen this morning has been mostly quiet sentiment, with investors remaining on the sidelines. Given the hike in the MPR, we're trying to then see how market participants react to this. What we've, however, seen so far has been a widening of the bid-ask spread. While bids have remained elevated and increased following the increase in MPR, we've seen offers remain relatively stable across the bonds curve. Like you noted, today would be having a Treasury Bills auction where a total of 213 billion would be on offer across the three standard maturities. The Treasury Bills side, what we have currently is a quiet market awaiting the result of the auction. On our side, we foresee a slight increase in the auction results owing to the recent increase in the MPR, as well as the relatively low levels of liquidity in the money markets.
And we're also recording a little bit of a dip in terms of the performance of the Naira at the NAFEX and I&E window, and also with the parallel market in focus as well. We initially saw some rally and a moderation. What's your forecast? Do you think we'll see a bigger dip as well there?
Well, as far as the I&E and the NAFEX goes, we expect some relative stability, not as much volatility as has been seen in the alternative markets. We expect that for the rest of the week, Naira would trade at the 440 handle in the I&E and the NAFEX. As far as the parallel market goes, what we're basically seeing right now is a correction of the rally that we had seen, I think, over the last 2 to 3 weeks.
And really, like you've also highlighted, investors are still waiting. It's been a wait-and-see approach, especially for the T-bills auction. That has not necessarily been enough to whet the appetite of investors or lift this quiet sentiment. However, let's talk a little bit about market illiquidity as we're gradually inching closer to the end of the month of November.
Yeah, so we've seen illiquidity in the market owing to some market activities that have taken money out of the system. However, that might, we might get some respite in that towards the end of the month as the federal allocations come into the system. So we probably might see a slight jump in market liquidity.
And what are some of the headlines we should also expect from for the rest of the week as we're looking towards Friday as well?
What we should also note is that on Friday we would be having the CBN's retail SMIs auction, where they would come to intervene for FX into the market for eligible market participants. And we know that would be the significant thing to note for the FX market. And in the fixed income market, we should start to see the bid-ask spread tighten a little bit as market participants, get accustomed to the new realities of where rates are going and where the board curve and the Treasury Bills curve sort of find their level. Later today, we would see the result of the NTB auction, where we would then have a clear direction across the shorter end of the curve. And then for the longer end of the bonds curve, we should see a tightening of the bid-ask spread as offers try to inch up to meet with the elevated levels of bids that we have currently.
And Dimeji, I like the fact that you're also bringing into focus the trading patterns as well. Talking about the short end and the long end of the curve, we've seen investor sentiments also shift in between these two lines. Now, we saw at a point in time the 2032 and 2037 papers hold investors' interest, and that shifted to 2050 and back and forth. Let's talk about the whole back and forth now and whether or not we can predict investors' next move beyond just the wait-and-see approach.
Yeah, so currently we have 3 new on-the-run bonds, which are the bonds that the DMO is currently issuing at the auction. We have the 29s, 32s, and 2037s. That's the reason why we've sort of seen more interest for those bonds. The thing to note is that the other bonds on the longer end of the curve, the 2042s, 49s, and 50s, are off the run. What that means is that the DMO is currently not issuing fresh supply of those bonds. And as a result of that, you would then have supply limited. Because of that, you have a situation where investors have to bid higher if they want to get the bond, as opposed to being able to take their bids directly to the primary market. So that's why you'd see in the secondary market there's been sort of shifts in the where we have interest from the on the run to the off the run bonds. Typically closer to the auction, you'd see a lot more interest in the on the run bonds, and investors try to trade those bonds ahead of the auction. And then after the auctions, and you see the attention shift back towards the bonds that are currently off the runs, as investors try to fill their demand in this bond from whatever supply that is left in the market.
And for the equities market, bargain hunting, cherry picking has been the order of the day. Now investors within the fixed income market are also looking at bonds with the bigger yields. Let's wrap up with that as well. Investors really need to get their money's worth.
Definitely.